So we are here today with my good friend Todd Libby from Three Keys Lending. We've talked to Todd in the past. He's kind of my go-to guy when it comes to loans for my clients. Obviously, people can pick whoever they're comfortable with, but I always recommend Todd because he knows what he's doing and he works really, really hard. And in all the deals we've done together, you've always gotten the job done. So that's why you're my guy. So. But anyway, I wanted to talk today, Todd, and kind of educate people who are thinking about moving to Utah and buying a house. So about a year ago, I was working with someone who was moving to Utah. I think it was from Oklahoma, and they didn't do a lot of prep. He thought, well, we were looking at homes kind of over the internet together, and he's like, oh, well, when I find one and when I move to Utah, then I'll just go get a loan, no problem, kind of a thing. Well, he ran into some snags, and I mean, mainly it was because he quit a job like 3 weeks before he moved out here. And so when he's trying to get a loan, yeah, he had a new job, but he'd only been there like 2 weeks or something like that. So anyway, he had some problems. So I wanted to talk today about, so if someone is moving to Utah, and they're going to buy a house, whatever the reason, maybe they're relocating for work or family or whatever it is, how is it the same or different if you're moving to Utah? And obviously you have to work with a lender who is licensed in Utah to get a loan on that property. What do they need to do? What steps do they need to take maybe before they get here and after they get here and all those types of things?
Great question. This is a really good topic. And first of all, thanks for having me on here. I really love working with you and enjoy talking with you and getting your insight. You've got a lot of good experience and help in guiding your clients. So this is it's an honor for me to be here. It brings up, I always talk about the three keys of getting the most or the best mortgage options. Moving impacts generally two of those keys. We're going to talk about income and the down payment. I know you mentioned one about the job situation. That's going to be the biggest one typically.
Mm-hmm.
When somebody's moving, if the easiest solution for it is if they can get an offer letter, if they have a new job already in place, assuming they have to have a job in place, they get an offer letter in place. And as long as, if we can close before they actually start, it's going to sound maybe different than what you'd think. It's actually better and easier if we can close before they start, because we'll take that offer letter as long as it's a salaried position.
Okay,
we'll
so not an hourly position. It has to be
not
salary.
An hourly position, salary.
Okay.
Yep. And we'll use that income, and we don't even need a pay stub. Which I know it sounds a little bit crazy, and as long as they're not working for family, that's another caveat that's not real common but has come up.
Okay.
So that's I guess the best case scenario, in my opinion. If they are going to start working before they close on their house, then we will have to get a pay stub. Typically, they're going to want one full pay stub showing a full 2-week pay cycle. Okay. So that's why it can delay things if they are going to start before closing.
Now, let me ask you this: if yeah. All right, so we're talking about a salary person, and most of the clients that I deal with, it's rare that they find and close on a house before they start their job. So my question is, they need that full pay period, stub information from the employer. Do they also need the offer letter kind of stating what they're going to make, for the year or whatever?
Possibly. It'll definitely help to have that offer letter, especially because maybe an underwriter would accept a shorter pay period along with the offer letter for this. So if that pay stub doesn't reflect the full normal amount that they would get, then the offer letter would help fill in that blank. And then if they are hourly, which is very common as well, typically they want the guidelines say at least one. My experience has been they typically want about a month of pay stubs when they're hourly.
Okay. So if someone has been in the job for, let's say, at least a month, they should be okay.
Right. Yeah. If we have a month history, now we're always going to go back, get the full 2-year history prior to that. But if they're on a new job and it's full time, whether it's hourly or salary, if they're on there for a month, then yeah, we're good to use that income.
Okay. Now you said, go ahead.
That's the only thing we may not be able to use if they get overtime, if overtime is new, or if they get bonuses. We can't use generally things like that. sometimes we can, if they have a history of receiving overtime at their previous job, we can sometimes make a case for it, but that's a little bit tougher when it's a brand new job and they don't really have much history
Okay.
of getting that overtime. Does that make sense?
Yeah, that totally makes sense. I can barely hear you now.
Oh, I haven't changed anything.
I don't know if it was my computer volume that went down or up. Anyway, it's okay. It's all right. All right. So you were saying though that you kind of slipped in something there that, unless they're working for family, does that like completely change their opportunity to get a loan, or is it just something else they need to overcome, or what's the deal with that?
With family, oh man, this would happen a few months ago. With family, if they work for family, I think they do. I think it's they just need to get a full month of pay stubs. I think the scenario where we can qualify them prior to starting the job, then that goes away. They have to be on the job and get the pay stubs. I think that's pretty much
Okay.
the solution to that.
All right. So there is a solution. That's good news, I guess.
Right.
Now what if a lot of people, for some reason, when they move to Utah, it's a sales position. Does that change anything when maybe, when you look at their yearly income, it's dead until March, and then, it peaks up and then comes back down in October. I mean, does that matter at all?
That is a huge. It has a huge impact. Yes, because we call that variable income.
Okay.
Whenever there's an element of variable income, whether it's bonus, commissions, any type of sales cycle in there, then the guidelines want to see technically they want to see a 2-year history. They can do it with less of a time. If they're if they're changing jobs, um, if they're not changing industries, we've been able to piece that together where they're basically going from one company doing the same type of sales to another one. But it is tough because now the underwriter's going to look at it like, well, you're in a different market now. Like we have
Right.
to really paint the picture like nothing's really changed. We're going to continue on. Many times they are given a base salary to kind of ramp things up, and we can use that. And I've worked with some employers to uh, I don't know, to basically convince them to write up, say, either increase that base salary to help it, knowing that they're going to make it. And if the employer is willing to help out that way, then because sometimes the base salary is pretty low and they won't qualify for that base.
Yeah.
But if they trust their employer and they know they'll perform. I've been able to get the employers to adjust that base salary, agree to
Yeah.
pay them a little bit more to help them out. Does that make sense?
Yeah,
Hopefully I'm
it
not.
does. And I think it brings up a good point that maybe, if somebody's watching this and they're thinking about moving, maybe this is something as they're in the negotiations of accepting a new job. And of course,
Yeah,
we're assuming that it's a job where, there is negotiating salaries and, perks and, medical or whatever it is. Maybe that's something that they could include in, the negotiation is, hey, if I'm going to move out to Utah, I'm going to need a letter, or, I'm going to need a base of a certain amount so that I can qualify for a home and, bring my family out here.
that's a great point. Yeah, that's a really good point about preparing ahead of time for that, knowing not only just saying, okay, yeah, no, I'm sure I'll hit my numbers, but thinking about no, what does that need to look like to qualify? Talk with a loan officer,
Right.
find out, talk with you to figure okay, what price range are we looking at now in order to qualify for that price range? Where do we need to fit in? If we're looking at a variable income type of situation, it can have a huge impact on them. Yeah.
Okay. Now you said, if they're staying in the same industry, so just a couple of examples here. So if someone is selling, well, I was going to say they're selling solar, but I think like 90% of all solar companies are based out of Utah or something like that. Anyway, but let's say they're, they're in some kind of marketing, or they're an appointment setter for solar somewhere, North Carolina, and they're moving here. If they're doing the same thing for the same company, well, then no problem at all. If they're switching to another company, but it's in the same industry, still they should be good with that. But let's say they are, again, and we won't even say sales, a corporate position with a, solar company, and they're moving to an oil and gas company. I mean, maybe they're similar, but they're different. Solar and oil and gas over here. So there's a couple of other hoops they got to jump through.
Yeah, they're gonna look at it like the biggest thing with income, they want to know about continuity. So if you can think about how to convince an underwriter that yes, this income is going to continue, um, and so they're going to look at the past to figure that out. What's the past history, and
Okay.
what's the likelihood of this continuing? If they're changing sort of industries, it's going to raise a lot of questions for that underwriter to know, how do we know if this
Yeah.
income is
How
going
do
to
we know
continue?
they're going to
We
make
don't have
this
any
money?
history of that in that industry, so that's a bit of a tougher one to
Okay.
they would they may have to wait. They may have to wait, or negotiate, like you said, negotiate a base salary.
Well, okay. You say maybe they're gonna have to wait. Wait, how long? 6 months, a year, longer, shorter?
They're gonna want to see 12 months at that. If
Okay.
it yeah, they're gonna want 12 months of that in that new job.
Okay. Is there anything they could do preemptively so that they wouldn't have to wait, other than what we've already talked about, is getting their employer to, you know, make some changes as far as, like, what their offer is and what their base salary is? Is there anything else they could or should be doing prior to moving out here?
Mm, yeah, besides getting some sort of base salary, if they're changing industries and it's going to be a commission or sales or
They're kind of
hotel,
starting over as far as the underwriter is concerned, and that's a red flag to them.
yeah, yeah,
Okay.
that's a really tough one because again, they don't really have any way to predict what that
Okay.
income is going to be.
Okay. Okay.
We
Now
can
I'm
look at bank statement
assuming,
programs.
my recommendation to anybody, as soon as they talk to me like, hey, we're thinking about moving out here, and I would say, listen, then today you need to call, Todd, and start getting the facts, start knowing what your situation is, so that you don't think everything's just fine. You drive out here with a U-Haul to Utah, and then all of a sudden, oh, we can't buy, we got to rent for a year.
Yeah, yeah, it'd be very similar to like a self-employed type of person as well. They're moving now, which is even tougher because self-employed typically is location specific. If you have a contracting business or any sort of construction, any sort of trade, if it's not location specific, then we could make a case for that. I have a client that has a moving company. He had offices in Chicago and Florida,
Okay.
and we were able to show that he can run that business from anywhere. He was moving from Chicago to Florida, and
Sure.
we had to jump through some hoops, but we were able to make it work, showing that
Okay.
self-employed. The
Okay, so you're talking about self-employed people. Let's talk about 1099 people. So, like someone who's a realtor, or in some other industry, just because they were doing great in Houston or Chicago, they're moving here, new territory. They got to find new clients. Whatever the case is, that's a red flag to an underwriter. So they're going to want to see a year before they're going to write a loan.
most cases, yeah.
Okay.
If you've already, I have one very similar case. Realtor moved from Utah to Florida. She'd been living in Florida, but she was maintaining her license in Utah, still getting closing clients in Utah. And we were able to
Okay.
use that income from Utah because she was living in Florida, bought a house there, but we used the income from her real estate transactions from Utah because she was maintaining that. So it's possible if somebody's moving from another state, but they're maintaining their license, in the case of the realtor, then we can use that income. I was able to make that work. Now, that was the one idea that I had. We do have options for. So let's say that we can't. An typical conventional or FHA underwriter won't use their income because it's just too variable. We can't predict what's going to happen. We do have other programs. If they have at least 10% down, we can use what's called a bank statement program, where we're just going to
Okay.
look at the deposits going into their bank account, and we're going to average their income based upon that. If they're and that works for 1099 people very well. So yeah, they have a little bit higher an interest rate, but it opens up other options if we can't find the more conventional type of loan
Okay.
options.
Okay. So let's shift it just a little bit. Another group of clients that I work a lot with are out of state people who want to buy a second home here in Utah, Park City or down in St. George, wherever it might be. And, all their income is made somewhere else, but they want to buy here. So first, number one, they need to use a Utah licensed lender. And two, what do they need to do, in order to get a loan here?
If it's a, this is where they'll need a decent down payment. If it's a second home, it's at least 10%. Investment property, they'll need at least, if it's a single family home, 15%. If it's, so the one advantage, if it is an investment property, we can usually use the potential income from that investment property to help them qualify.
Okay.
So it's a very similar thing. We'll look at their current income. We'll obviously have to count their current housing payment with that and the new housing payment. And if it's a second home, then we can't really count any income on the new one. But if we do it as an investment property, then we can. If one scenario that has come up for people that are buying a condo in Park City, for example, you have to be careful, because if anything in the documents show that it's zoned for nightly rentals, that's going to turn into a non-conforming condo.
So even though they have no intentions of doing an Airbnb or anything like that, because it's in a zone where it can be, that's a problem.
That's a problem. Yeah, it's labeled as a non-conforming or non-warrantable condo.
Okay.
And there's not many options, but I do have a couple of good options for non-warrantable condo.
Okay. And I know you've worked it out. You've done it with several clients, and that kind of thing. So I know it can be done. I just want everybody to kind of understand that there are some extra steps that people need to follow to get these loans and to get the best loan possible. Of course, everybody wants that. And, as you are looking for properties, if you find two that you really like, and one is in a zone that, has nightly rentals and one is not, well, that might influence your decision a little bit.
That's a great point. Yeah, because we'll get a better rate if we can go a more conventional type of loan versus the non-warrantable.
Well, okay, now that brings up, I guess, a question then. When you take Park City, it's very clear they have maps. This is zoned and this is not zoned for nightly rentals and things like that. But let's say you get out of Park City. Let's say you're in Oakley or Heber or somewhere that's not known for nightly rentals. A lot of places allow it. Or let's say this: a lot of places don't not allow it. You know what I mean? And so because it's not specifically zoned for it, but it is allowed. Does that automatically, like you were saying before, does that automatically make it a non-warrantable property?
Only if there's something if there's an HOA, if there's anything in those HOA documents that reference short-term or nightly rentals, that's what's going to trigger it as a non-warrantable. If there's nothing in there, even if it's allowed, if they don't really specifically call it out, then no, then they could get conventional financing on that. But the underwriter will review any of those HOA documents, and they'll find if it's in there, they find it. But yeah, that's what it would come down to. What's in the HOA documents?
Okay, sounds good. Is there anything else that people ought to know? Obviously you know way more about this than I do. Is there something that I'm not asking that people really ought to know?
Well, as I was thinking about this, the three things that came to mind for me were the income piece is the biggest one for when moving to a new place. The down payment piece, if somebody is selling a home, or if they're going to sell their home after they buy here, that's also, in my experience, a very common scenario where in order to buy the home here, they need the money from the sale.
Right.
So there are things that are called bridge loans where we can take the equity from their current home if they haven't sold it, basically pull that money out as a bridge loan, use it to buy the new home. The biggest challenge I see with that is that the lenders that I know, we have to then qualify them with all three payments: their current mortgage, the bridge loan payment, plus the new one. So that can be a challenge. So so that's another part of the conversation is, what are you doing with your current home? Do you have to sell it? Is it already listed? Where's the down payment going to come from?
Okay, makes sense.
The other piece is working with somebody that knows the location and the seasonality of Utah, and you can that would be your expertise of knowing, well, hey, what does it look like to buy a home in November, December, as opposed to July and August?
Right.
It's a different market. Right? Do you have any comments on I guess the seasonality of buying in Utah?
Well, the season here in Utah, I mean, as soon as we hit April, it's buying season. It goes through September, and kind of tapers out into October. So, of course, this year, who knows, because of interest rates and all the other new wonderful programs the government is putting on loans and things like that. But yeah, I mean, typically down here in the valley, April through September, those are the hot months. Now, Park City, that kind of flips around a little bit, as well as St. George, because of how, properties are seasonally used in those places.
So that'd be my only comment, is to make sure they're working with somebody that understands the seasonality and the different locations of where they should be looking. So that's
Right.
my, I guess, my
Right.
plug for you, because you have a lot of good experience working here. If that's
I
okay.
think so.
Can I put a plug in for you here? Is that
Yeah.
okay?
Thanks. Shameless plugs are always
All right.
welcome. Well, hey, good information. I'm going to put Todd's contact information in the comments below. If you have any questions about anything, Todd is great to work with. He gets back to people quick, very professional, and obviously very knowledgeable. So, if you have any questions, call him, call me, put it in the comments, anything you want to do. But thank you, Todd, for being here today. We're going to do another video, I think, pretty soon about some of the new stipulations on loans and things like that. So I hope people will tune in for that and see what's going on.
Good. Thank you so much, Matt.